I believe that we are going to see very slight deceleration as a result of weakening of domestic demand at a time when external demand still looks very good because Chinese companies are rushing to ship their products to the US before the tariffs kick in, especially at the 25% rate at the beginning of next year. The key is output. Is output going to held up pretty well because people are betting on policy stimulus, or is it going to sink with domestic demand, with weaker consumer confidence? My bet is that there is so much noise from policymakers about a strong stimulus they are beginning to implement that production will hold up quite well. And we are only going to see a modest deceleration of Chinese growth in the second half of this year with external headwinds fully compensated for by domestic demand, in particular infrastructure investment.
What are the implications, do you think, of the recent move we've seen in the weakness of the renminbi and the US Treasury Secretary's insistence that now the Chinese currency should be part of some negotiated trade agreement?
Everybody is watching the headlines regarding the US Treasury report on global currency policies to see if renminbi will be called a currency if China will be called a currency manipulator. We believe that it will not be because China is not manipulating its currency. They are actually doing a lot to slow its depreciation, and it doesn't meet the criteria that the Treasury applies to currency manipulation. What will happen though is once it's clear that they are not called a currency manipulator, renminbi will weaken, because the market will say, well, Beijing has less reason now to prevent further depreciation. So we would expect a little bit of weakness going towards 7. However, we do not believe that 7 will be crossed because this would trigger massive capital outflow. There wouldn't be enough money left in China to sustain growth, and Beijing will probably choose to spend currency reserves to defend 7, then allow this massive capital outflows to be triggered if the currency goes past this level.
Dariusz, full market economies very often fail to offset recessionary influence as well. And I read with interest the Goldman Sachs comments on Apple and the big decline we could see in smartphone sales in China in the coming year as well. But with both of those factors in mind, what hope of a command economy of averting a meaningful slowdown?
The Chinese version of the command economy has proven to everybody over and over again over various episodes of global slowdown that it's doing very well, that policymakers are able to sustain aggregate demand through, in particular, infrastructure spending. And it's clear to us from all the communications we've heard from Beijing that this is what's going to happen this time as well. Acceleration of shantytown redevelopments, more infrastructure projects, be it highways, railways, ports, subways, and so forth. And remember that contrary to popular opinion, China still has a lot of room to boost infrastructure because coverage of its territory with railroads and highways is actually not that dense. So there's a lot more room. They also are able to push their banks to fund such infrastructure spending. That's exactly what we are going to see. We have not revised down our growth forecast for this, next, or following year as a result of the trade war with the US, because we believe that external headwinds will be fully compensated with domestic demand. Unfortunately, the price to pay will be a reacceleration of leverage buildup and a less sustainable growth in the long run, but I guess the market will worry about it later. In the medium term, I think China will hold its ground.
Let's get one more quick question in from our guest, Thanos.
Yeah, hi. Let's suppose that there is no deal between the US and China on trade this year, and the US increase the tariff rate to 25% next year. Will China retaliate, and how?
There will be no deal in our opinion. In fact, we assume that by Q1 next year, the totality of trade and goods flows between China and the US will be under tariffs. And on the US side, it will be a 25% tariff. China still has a little bit of room to retaliate because they have retained $50 billion of imports from the US that are not yet subject to Chinese tariffs. So they will probably retaliate by imposing some tariffs on the remainder of US exports. They will probably also throw some obstacles in front of US exports on the non-tariff front. will make it more difficult for US businesses who need to import some commodities from China, such as rare earths, to do so. But what China will not do would be weaponizing the currency and depreciating it to regain competitiveness. It would be, on balance, disadvantageous for Beijing, and they will not go down that route. And China will also not use its treasury holding to sell it and thus pressure the US to change its policies. This will not happen. So we are probably in for a protracted trade conflict, but one that is largely limited to obstacles to trade and investment, rather than a broader financial conflict that a lot of people fear might happen.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.